Ever wondered how traders predict market swings and make profitable decisions? The secret lies in understanding implied volatility. Implied volatility, IV, is a forward-looking measure derived from option prices, reflecting market expectations for future price fluctuations. Unlike historical volatility, which looks at past price movements, IV gives traders a glimpse into the future. Higher IV suggests greater expected movement, while lower IV indicates stability, crucial for assessing risk and determining fair option premiums. IV helps traders identify overpriced and underpriced options, ensuring they don't overpay for contracts. It also aids in risk assessment, signaling increased uncertainty in the market and helping traders adjust their strategies. Different trading strategies thrive in varying IV environments, making it essential to know the current IV level. Before major events like earnings reports, IV tends to spike, allowing traders to anticipate potential price swings. Investors use IV to hedge against market volatility, protecting their portfolios from unexpected price movements. Implied volatility is calculated using models like Black-Scholes, taking into account factors like current stock price and time to expiration. As IV increases, option premiums rise, making options more expensive but potentially more profitable. Call options become pricier with higher IV, benefiting those who already own them. Similarly, put options also increase in price with higher IV, favoring traders holding puts. In high IV environments, selling options can capitalize on inflated premiums, using strategies like credit spreads and iron condors. When IV is low, buying options becomes favorable, with strategies like straddles or long calls and puts. Unusual spikes in IV can indicate upcoming market events, helping traders adjust their strategies. Managing risk effectively involves understanding IV, adjusting position sizes, and employing hedging strategies. Straddles and strangles are ideal for high IV expectations, benefiting from significant price movements. Iron condors and credit spreads profit from time decay and declining IV, suitable for high IV expected to drop. The VIX index, known as the fear gauge, reflects market expectations for volatility in the S&P 500, guiding traders on overall market sentiment. Mastering implied volatility can significantly enhance your trading success, making it a vital tool for any options trader.